Hello, everyone. It is Tuesday, October 11th. Today, we're going to be talking to Bob Lang from Explosive Options. We'll talk about this choppy day, how that fits into the big picture with further price deterioration. Tech, communication services, both down over 1.5%. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts. We focus on tools, education, and commentary to equip you, hopefully, to navigate uncertain times like this. Just talking with my guest, Bob Lang, before the show, talking about ChartCon 2022, which we just wrapped on Saturday. It was a ton of fun, with a lot of great presenters, a lot of great discussions. My mind is swimming as I'm trying to regroup from everything that happened there as we try to get back into the normal routine. But I tell you what, a lot of the conversations focused on days like today, which is a choppy day in the midst of what I would argue is still very much a bearish environment. Think about the growthy areas of the market like technology, like communications, both pushing to the downside. But look at all the charts here in a few moments. I did want to let you know about the upcoming guests. Excited to talk to Bob Lang today here in a few moments. Tomorrow, on Wednesday the 12th, Art Hill coming to us from Belgium. On Thursday the 13th, Katie Stockton from Fairlead Strategies. Next week, on Tuesday, October 19th, Hema Reddy will be joining us for the first time. I've known Hema for a number of years. She's written books on Gann analysis and other similar methodologies. So we're interested to hear her take on what's happening in the markets. Let's get to our market recap. We did have a poll recently on StockCharts TV. As a reminder, on our live stream page, we always have a poll going on the right side of the screen. We also do polls on our social media accounts, so give us a follow on Twitter. Subscribe to our YouTube channel. You won't miss one. We asked you recently, which of these would you rather own over the next 3 months? Consumer discretionary, consumer staples, or cash? Half of you said cash, which is what a sign of the times. Talk about offense not working so much, which is what's happened with the XLY. You have some of the mega cap names like Tesla and others certainly struggling, Amazon in there as well. Consumer staples in a defensive tape. I would normally think there'd be a bunch of votes for consumer staples, but those haven't particularly been working either, right? Because interest rates are so high, the dividend component of consumer staple stocks, which usually fairly attractive, less and less attractive as you can get a decent income from a bond, to be honest with you. So half of you saying cash. I did not vote on the poll. I would have done 2 votes for cash, most likely. Had I been given the option, I would set up a fake account to add another vote for cash, probably. I mean, we're very much certainly in the defensively minded camp, as we've articulated in a number of ways. However, whether or not you describe yourself as bullish or bearish, I've always found, don't limit yourself to that label. Focus on the evidence. Let the markets tell you when you should be changing your perspective and changing your position. So let's look at the evidence that the market's actually providing for us today here on a market recap. The Dow actually narrowly finished positive, just above there, sort of chopping around quite a bit here in the afternoon, but finishing just narrowly in the green. The S&P down about 0.7%. Just below 3590. We have the NASDAQ composite down 1%. So it was really sort of the tech and the mega cap tech in particular struggling and pushing the markets lower. The VIX continuing to move higher, actually, up above nearing 34. It's interesting. We've talked about how the market has often bottomed in 2022. I mean, I think pretty much all the times it's bottomed, we've seen a VIX above 30. So the fact that the VIX is once again above 30 makes you immediately think, all right, we just need to look for a bottom. And that may be true. All I will tell you, though, and we had this as one of our 3 and 3 charts yesterday, look at when the VIX first went above 30 back in April. And think about how long it was between that moment and about 6-7 weeks later when the market actually bottomed out in June. We're in a period of elevated volatility, if not excessive volatility. I think that's going to be the norm as opposed to an outlier in 2022. Bond markets back open today. They were closed yesterday for the Columbus Day holiday, back open, and the 10-year yield almost made it above 4%. Not quite there, finishing the day around 390. And again, that is high or low depending on your time frame. If your time frame is the last 2 years, that feels super high. If your time frame is the last 40 years, interest rate's still pretty low relative to long-term averages. And I think that's an important thing to reality to consider. Dollar index, not much change from yesterday. We've talked about how the dollar is sort of the wrecking ball for risk assets. No real continuation of that trend today, more sort of a wait and see mode there. Commodities mostly in the red with the DBC, which is a broad commodity ETF, certainly a heavier exposure into energy than other commodities, down 1.4%. Finally, cryptocurrencies mostly in the red with Bitcoin just below 19,000, Ether below 1,300. So go to chart of the S&P 500. I was doing an interview earlier today for Insider, a former Business Insider. We were talking about sort of an outlook between now and year end. We talked about sort of all the different competing narratives, but in the end, I think a lot of the narratives pointing to the likelihood of further price deterioration. News we get from the Fed is not, in my opinion, we're done and things are going to start improving. It's more of we have plenty of time and plenty of runway left to continue to tighten their, have a tighter policy. And we've seen what that's done to value stocks versus growth stocks. We've seen what that's done for our growth-oriented benchmarks. The S&P today, not quite making a new closing low for 2022, but really, really close. We actually underticked it on an intraday basis to make a new 52-week low on a closing basis, not quite underneath the low from the last week in September, but certainly at the new lows there. And again, it's when you look at the last couple of months, right, the last 4 months, look at the low in June, the rally in August. Remember how encouraged I think so many investors were, almost euphoric as the market's rallying higher, overbought for the first time since November of last year. Hits the 200-day moving average, and look how quickly that just turns right back to the downside. This is why, and I think patterns like we've seen, and with these false sort of breakouts in early September, again in early October, it's a fickle market, and at the end of the day, that short-term optimism ends up being short-term optimism, not a longer-term structural change. These tell you people want things to get better, not necessarily that they are getting better. Again, the best evidence you have is price. I got to spend some time with one of my mentors, Ralph Acampora, over the weekend, and as part of Charcon. And again, he could not stop reinforcing the message that price is king. If you know nothing else, look at the message that the markets are providing. So as I'm looking at the charts today and for preparation for the show, I see a lot of trends that are going down. It's not all bad though, and we're going to look at some of the areas of the market through the course of today's show where we are seeing some, potential cause for optimism. And it's in areas we've talked about, things like renewable energy, things like traditional energy, areas like healthcare. We've actually seen some nice bounces. Continuing on our market recap, just really quickly on sectors, REITs were actually number one. That's unusual. We haven't had a lot of REIT at the top of the sector list kind of days. The real estate's a fairly defensive sector, but has absolutely gotten crushed recently. It's been one of the worst performers in recent months. Again, REITs tend to be a little more defensive area of the market, certainly a higher dividend component. But again, the challenge for REITs and utilities and others like that is there's often not a great reason to own them except for the dividend component, arguably. And when that is less attractive because interest rates are so high, there's just not as much to be excited about. For today, though, real estate up 1%, consumer staples number 2 up 0.8%, healthcare number 3. Those are the only 3 that finished in the positive. On the downside, you have communication services and tech, both down over 1.5%, followed by financials after that. Now, financials are an interesting area of the market because earnings season is going to get started here very soon. On Thursday, we have some companies reporting. On Friday, it's a number of banks, things like JP Morgan and others actually reporting earnings starting Friday. Going into next week, that's when things will start to accelerate. I don't know if I'm optimistic going into earnings season. Probably not. I think it's more just, I think you will find a recognition of the challenges that we face. But it'll be very interesting to hear the language on some of the calls and some of the ideas that we may hear. Just to finish off, I wanted to look at what I call the phenomena stocks. These are the sort of FANG and FANG-like names. If we look at the list here, you can see what happened today. All of them to the downside here. Adobe and Alphabet, the best performers, still down. The worst performers, Netflix, down almost 7%. Meta down 4%, making a new low. Microsoft making a new low for the year. Amazon making a new low for the year. So, if you do find yourself in not a new low for the year, but a new low here since the August peak, when you're looking at charts like Microsoft and Meta and others, how optimistic can you be? How bullish do you want to be when Microsoft is making new 52-week lows? I would argue probably not so much, because it's not just about Microsoft, but it's what Microsoft represents as a mega cap growth name that should be driving the markets higher if conditions are good. When conditions are poor, it's driving things lower. Now that Amazon is sort of cutting below its recent lows, I think you go down to the 100, 105 sort of area. That's May and June. It's a nice haircut from where we're seeing right now. It's another 10% below current levels just to reach the next support level. That's the reason, or I think that's the opportunity for the market to go lower. I'm seeing patterns on some of those individual growth names that certainly open the likelihood of something like that occurring. Let's take a quick commercial break. We'll be back with today's guest, Bob Lang. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. It's great to be back live now that we've wrapped ChartCon. We're excited to continue on and share ideas and observations with you. A couple quick announcements before we bring on today's guest, Bob Lang from Explosive Options. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. Larry Williams is recording an updated market outlook, which we will be posting shortly. All of our shows are back to their regular programming schedule, including this show with a lot of great guest interviews. All of that is available for free at StockChartsTV.com. Or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Bob Lang. Bob's the president of Explosive Options, coming to us from the Boston area. Good to see you again, Bob. How are you?
I'm great, Dave. It's always great to be on the show with you. It's an interesting market we have right now as we come into the end of the year, and a lot of volatility here and lots of opportunities, as you said.
A challenging day among challenging days, it feels like. We're starting with your chart of the S&P 500. Can you talk us through what you're seeing this week?
Yeah, so Dave, as technicians, we're pretty much pattern followers. We look for patterns that repeat over and over again, and sometimes I look at little patterns that kind of stick out to me like a sore thumb. And this particular one, Dave, as you can see from back in September, we had a nice rise up to that 20-day moving average and then a rejection the following day. Now, that was, if you recall, that was CPI day, when the day before, where the red bar is, that was the day the CPI came out for August, it came out in September, and we had a big, huge gap down, closed nearly right on the lows of the session. But on those 2 days, Dave, that Wednesday and Thursday, we had the price oscillator, which is one key indicator that I follow, went from up to down. And why was that significant? Well, look what happened the following 9 days, straight down, like you're going down a roller coaster. And we didn't stop for about 370 some odd points. Well, fast forward to last week, and you can see on Thursday and Friday, very similar looking 2-day pattern, Dave, where we fell on Friday after the jobs report. And similarly, the price oscillator went from up to down. So, I mean, if patterns hold here, we're looking at probably another 370 point move down in the S&P 500, where you can see I've marked that to be about 3280 to 3300. And, could it come quickly? Well, the last one took only about 9 days to get there. So we'll see what happens.
When your price objective cuts into the indicator panel, that tells you something about where you're at within the prices, right? Making a potential new low there. Second chart is looking at a breadth indicator we've talked about before. Talk us through this one.
Yeah, Dave, I know you're familiar with this one because you use it a lot, and you tweet this out quite a bit along with other breadth oscillators. So I like to look at the S&P 500 50-day moving average in stocks above their 50-day moving average. So I put a box in there, a blue box there, and anything below the box, I always say, is no bueno for the markets, and anything below that box is under 50%. So currently, as of yesterday, it looks like we had 14% of stocks that were trading above their 50-day moving average. So flipping that around, minus 100, 86% of stocks, Dave, that were in bear markets or below their 50-day moving average. So that is about 430 stocks out of the 500 that are technically in bear markets. So at this point in time, listen, I mean, if you're looking for a rally, it's not going to be anything that's strong enough to call a bear market bull market. Look what happened last week, Dave. We had a big rally on Monday and Tuesday, and you could see that indicator there. It rallied up to about 30% and rolled right over. So there's just not enough strength and not enough buyers coming into this market right now to take it up. It'll change one of these days, but for right now, the trend is the trend, and it's down.
Not today. Your final chart's the NASDAQ 100, the NDX weekly chart, though.
So I fanned out on the weekly chart here, Dave, on the NASDAQ, and we noticed that I have the 200-day moving average there, which is the black line, the flatter one, and the price has rolled underneath this moving average. So this is a key move here in the long term and even the intermediate term. So there's a lot of distress right now in the NASDAQ, and you've obviously mentioned that with names like Microsoft and Amazon, Apple, in Netflix and so forth. These stocks all hitting near 52-week lows, and you can see clearly the NASDAQ is more than a 52-week low. We haven't seen these lows since back in the middle part of 2020. So there's a lot of distress here. And as far as my work is concerned, I can see this index getting down to about 8,500, maybe 9,000 at best, but probably 8,500 or so before we get some sort of a bounce. But this is a pretty severe move down, and it probably has a little bit more to go.
Now, how do you, we only have about a minute left, Bob, but given those assumptions, which I can't disagree with, I totally get the approach to it. What do you do as an investor during this period? I mean, is your general approach to get defensive, to just, get away from it and just back off and look for particular signals? What would you tell investors who are struggling to kind of navigate this type of period?
You got to pick up the bear playbook, Dave. The bear playbook says, have a lot of cash, have some protection, keep your positions small, take profits when you have them, even if they're small, it doesn't matter, and be willing to play both sides of the market. So that's pretty much it. Especially, I mean, the most important part is holding a lot of cash, because at the end of this bear market, I always tell people, over Bear Mountain, there is going to be a bull market. It's going to start at some point in time. We don't know when it is. We're not there to figure out when it's going to happen. Is Bear Mountain out there in Washington? I don't know. Is there a mountain named after bears out there? But at some point in time, the Fed will be done raising interest rates, and they're going to stop, and the economy is going to settle down. But right now, there's just a lot of people's hair is on fire at this point in time. So I think if calmer heads are going to prevail, and I think if you use that bear playbook carefully, you're going to make it out in the end.
Really appreciate some charts and some perspective here on a day like this, Bob. Thanks so much for joining us. Stay safe there in Massachusetts. We'll talk to you again soon.
Thanks, Dave. Great to be with you.
That's Bob Lang. Bob's the president of Explosive Options, coming to us from the Boston area. We also chatted a little bit about Boston. I lived there for 8.5 years with my family. My son was born there. I would love to get back there at some point. And I loved his take at the end. I mean, if you listen for the evidence that appears, fairly negative, what strikes me about my conversation there with Bob mirrors a lot of the conversations I had with Larry Williams and Ralph Acampora and Martin Pring and Jay Woods and Ms. Schneider and all the other guests we had in town for ChartCon. It wasn't a depressing, this is the end of the world. It was sort of the reality of this is what a bear market is like. And it's not a judgment call, and it's not an optimism versus pessimism thing. It's looking at the evidence. And as Bob, I think, very, very, very beautifully said, is sort of, you're looking for when, the patterns start to improve. You're looking for when that trend is reversing. We're not seeing it reverse today. Great take there from Bob Lang at Explosive Options. Let's continue on our show today with the Final Bar mailbag. As a reminder, the mailbag's always open. We'll do our best to get back to as many questions as we can. Our email is thefinalbar@stockcharts.com. And let's get to question number one. Dave, on a recent episode, you said normally bonds recover first, then stocks, and then commodities. Isn't DVN a commodity stock? And I love that question. cutting to the heart of it, right? You're actually listening to what I'm saying and asking because it appears to be a conflict, and I can't disagree with you. That whole idea of bonds tend to improve first, and then you see stocks and then commodities. That actually came from Martin Pring. As a StockCharts member, you have access to Martin Pring's methodologies, his articles. He wrote an article recently talking about the bonds versus stocks versus commodities. He wrote this on September 18th. If you're a StockCharts member, I would go back and view that members only article. It was really, really well done and sort of described in a little more detail that relationship. And it's the reality, right? If you think about what the benchmarks are doing now, moving higher, the benchmark's moving lower because interest rates are going higher. I think the only way that our growth-oriented benchmarks really start to improve is if rates start to come down or stop going higher. The way that you can see that is if bond prices improve. So if you look for an improvement in bond prices, an improvement in stock prices is probably pretty close or most likely to come after that. But your question is, if that's true, how come DVN is a good chart? Because isn't that commodity? So what you have to remember is things are all sorts of different. And I would say that relationship of bonds, then stocks, commodities is an idealized cycle. And I would love to tell you that every time it's just bonds and then stocks and then commodities, then you just wait for bonds to turn lower and then stocks and bonds. If it was that easy, this would not be that hard. And we would all just be following Martin Pring's idealized cycle and we'd be done. Anything about sector rotation, if you look at Julius de Kempeter's work with the RRG, Sam Stovall's work on offense versus defense, there is the idealized version of what tends to happen. And then there's the reality of what happens. And the reality is driven not just on one set of comparisons, but the markets are a complex mechanism. There are a lot of things going on. Within energy, you have a lot of things going on, right? In terms of clean energy and what that means, clean energy policy, how traditional oil and gas companies are navigating through that period, how they are trying to pivot to and the rise in electric vehicles, and also the reliance on the economy on traditional fossil fuels. I had great conversations with Greg Schnell over the weekend, particularly on that topic. So oil prices going higher certainly would make energy prices go higher. They don't care what the idealized cycle is. It's more going to be driven, I would argue, on that versus anything. Having said that, so I think the idealized cycle is important. That's why I think bonds most likely lead stocks. However, there's no guarantee that's going to happen. I think regardless of what cycle you might be paying attention to, focus on the evidence. I'm going to want to own stocks and sectors and charts where the relative strength is improving. Energy, arguably the best of those today. Question number 2. Gold 1680 support has broken, and you sent a chart, which I'll bring up here right now as I'm reading your question. Gold 1680 support has broken, so my take is that opens up 1450 or even the 2019 breakout at 1350 as a downside objectives I think you're describing. You seem to have it as a short-term long. You sent that in, and to be clear, I'm not making a recommendation on anything, so I have to get that disclaimer out there as always. However, I think we highlighted this because it's so overbought. And if you look at the chart of gold, this is your chart that you sent me, look at the bullish momentum divergence, lower lows in price, higher lows in RSI. You're seeing also a bullish divergence with MACD. So I think what I was trying to point out there in a recent episode was the fact that bullish divergence has occurred. What you have to remember is that does not guarantee we're going to go higher. And I would love to see the price confirm what we saw from that bullish divergence. The bullish divergence is what puts it on the watch list. That's what raises the red flag of a potential trend reversal. The price actually reversing is what causes that confirmation. So gold's still below its 50-day moving average. I'd love to see it get above there. It's making a new low in the last week or two. I would love for it to stop making new lows, right? It tries to make a new low and fails, makes a higher low. That would be encouraging to me. So I think we're seeing some potential leading indicators indicating gold at a bottom. I'm not seeing the price action really justify that just yet. And I think that's how it mirrors. The fact that it's broken below the 2022, 2021 lows, I don't think that's a good sign for gold. And I'm looking at 1450, which is that low from the fourth quarter in 2019, first quarter of 2020, which you highlighted in your question. Great chart. And thanks for asking about the difference between, I think, the short-term divergence and I think the long-term downtrend. Next question, Larry Williams recently mentioned his indicators, the Williams cycle forecast and Williams true seasonal. Where can I find these on StockCharts? Thanks for asking about those. In Larry's presentation, he did a keynote presentation at the end of ChartCon. It was really thought-provoking, and if you missed it, you missed out on that one. It was really, really well done and highlighted a lot of cyclical patterns, some of which I was very familiar with, others I had not used before. Larry has a plugin as part of our ACP plugin environment. And I think it's called, I actually forgot what it's called, Larry Williams Stock Trade. I was going to say, I knew it was something with his name in it. If you go to ACP, which I have here, click on the little plug icon. That's the ACP plugin environment. If you look down this list, these are a series of plugins that we have. Some of them are free, like our StockCharts Advanced Indicator Pack. Dave Landry has a free plugin, which is really, really interesting. We also have premium plugins from people like Real Motion, Go No Go Charts, Simpler Trading, Art Hill's Trend Investor Pro plugin, and Larry Williams. Larry's plugin, which is a premium add-on to StockCharts ACP, includes those indicators that you mentioned. So if you see the results that Larry was sharing in his presentation, you can use some of the indicators he was using to derive those conclusions that he shared on the show. Final question, just briefly. I was stunned to hear that you don't typically buy individual stocks, as you don't find it to be worth your time. May I ask you what you do buy? I probably completely fumbled through something, basically saying I don't buy individual stocks. And that's for the most part very, very true. And I really don't. Part of that, I would say, comes from my institutional experience. When you work at a place like Fidelity, there are so many restrictions on what you can actually buy or sell in your own personal account, because they want you, rightly so, to focus on your clients, right? And the shareholders of the company, and make sure that they get your ideas first. Part of the CMT designation that I have is agreeing to abide by the ethical standards. And part of that is to make sure that if I have any brilliant idea, that I get it out to clients and users and viewers and subscribers before I would take any action in my own personal account. So a lot of people do that very well. And I can think of a number of them who are really good traders and have a really good research or education product. I have never been able to separate those very well at all. I know what I'm good at, and balancing those effectively is not good. So instead of risking doing something unethical, which I certainly do not want to ever intend to do, I basically just don't trade a lot of individual stocks. So I do trade ETFs, and I disclose that randomly if I talk about one that I own, but I rarely do it very actively. I keep things fairly long-term and try to keep my observations focused on you guys and my premium subscribers at Market Misbehavior. We need to wrap the show. The show is so much fun. It's great to get back in a routine. Thanks for letting us take a brief break for ChartCon. We're back live now, and let's hit on the 3 in 3, starting with Microsoft. As I was talking with Bob Lang, we talked about my comments in the market recap about how bullish do you want to be when Microsoft is making a new low. And again, it's not a one stock universe. I know that there are a lot of names with a lot of different competing themes, but a chart like Microsoft, I think, represents that mega cap technology trade. And if a stock like this at, whatever it is, 1.7 trillion market cap, one of the largest companies in the US, when that's making a new 52-week low, I don't know how optimistic I want to be. And I'll tell you, I want to be very defensive, because that's telling me that the trend is down. Microsoft keeps making lower lows. When that stops happening, we can talk about how encouraged we might be about the upside potential for stocks. Chart number 2 is interest rates. I was doing an interview earlier today with a media outlet, and we talked a lot about interest rates, talked about Fed policy and how that relates to the technical perspective of looking at price, breadth, and sentiment, which is really important, I think, to consider as an investor. 10-year yield almost went above 4%. Didn't quite do it today, but very, very close. Rates are at incredibly multi-year highs, which is extreme if your time frame is the last 2 years. It seems like this has gone vertical. However, if you look back at the last 10, 20, 30, 40 years, you can recognize the fact that rates still have a long way to go before they even hit the average reading on the 10-year yield going back over that period. Now, why is that important? Because as rates have gone higher, starting at the beginning of August, value stocks have been handily outperforming growth stocks. So it's not just that Microsoft's going down, it's that value stocks are outperforming those stocks, as a result, outperforming their benchmarks. Final chart, the Travel and Tourism Index. This index appears at the top of the list or at the bottom of the list, and it just depends on any given day. Randomly, I'll get people highlighting, look, airlines are up 5, 10%, cruise lines are up significantly. And even in this bear market phase, we've seen that happening. Take a step back and reflect on the fact that overall this index, in my opinion, is still going lower, making a new swing low here again today. This is a group and an area of the market still suffering. Folks, that's a wrap for the show. I want to thank Bob Lang from Explosive Options joining us from Boston. All of our previous discussions can be found at stockchartstv.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.